Hello everyone and welcome back to the Week in Markets here at True Potential. I'm delighted to be joined by Sebastian Mackay, my colleague on the investment desk. Now it's Thanksgiving in the US this week, so it's been a rather shorter week than normal. We've had most of the economic data through Wednesday in the week. What we thought we would do for you this time round though is take a step back and reflect on US exceptionalism. And the reason for that really is an announcement that began the week, which was the nomination for US Treasury Secretary of Scott Bessent. So he is seen by markets perhaps as a more credible figure than President-elect Trump could have chosen. So Sebastian, I guess the bond market reaction is really what we focused on at the start of the week.
Yeah, just going back to the anticipation of the Trump victory prior to the election, the bond market didn't really like the Donald Trump victory as an outcome. So we saw bond yields rise, bonds sell off in anticipation of the election result, and bond yields rose a little bit further after the election result, really on the expectation that there would be larger fiscal deficits, tariffs, inflationary policies that might mean that interest rate cuts that had been expected might not come through. So the bond market had been a little bit nervous about a Donald Trump victory, but the appointment, as you say, of a credible Treasury Secretary has calmed some of those nerves. So we've seen a rally in the bond market since that announcement. We've seen bond yields fall reasonably significantly since that.
And that's important, isn't it? So if we reflect on this occasion versus when Donald Trump was first elected back in 2016, bond yields kept rising for the first 6 to 7 weeks after he was elected, whereas this time they're now lower than the election, really indicating markets are perhaps reassured and that risk premium from uncertainty has been forced out of the bond market to some extent.
Yeah, I guess there's a few things there. First of all, the starting point is much higher bond yields than we had back in 2016. Secondly, although you can never really say this for sure, but to some extent Donald Trump is more of a known quantity than he was back then. I don't think anyone's really got into the mind of Donald Trump, but I think we know a little bit more about his policies than we did back in 2016.
We probably do. And something that he is likely to continue is the size of the US fiscal deficit. So in the last week or so, we've had confirmation that the fiscal deficit in the US for the fiscal year just passed rose modestly to 6.4% from 6.2%. But again, the bond market doesn't really seem that concerned by more borrowing from the US, probably because of the growth backdrop that it is fueling growth rather than fueling inflation.
Yeah, I mean, the US exceptionalism extends to it being the reserve currency and still being the reserve currency of choice, although there was that period after the Russian invasion of Ukraine when the dollar lost some of its reserve status. That was really quite limited, and it was only a few countries that diversified their holdings into non-dollar assets such as gold. But primarily the dollar remains the global reserve asset. And so the US can afford to run larger deficits than other countries because there is always that demand for US bonds, US Treasury government bonds that exists. That means that the US is just able to fund larger deficits. And those deficits have benefited the private sector of the US economy. So households and companies have benefited from those transfer payments effectively from the government to them, and that's boosted growth and helped that kind of wedge between US growth and the rest of the world.
So if we focus in on that, something that you and I spoke about previously calling the European malaise versus US exceptionalism, so that is this growth wedge where the US does appear to be experiencing a much higher level of trend growth than it had experienced before COVID, and it's enjoying this growth boom, whereas Europe, including the UK, seems stuck in a rut. And you've mentioned previously on this forum about German politics being difficult, but now it seems to be French politics which is going to challenge the growth story.
Yeah, I mean, the major economies in Europe are really facing kind of fundamental questions about their structural growth model. For Germany, they've had an export-led growth model that's been very dependent on particularly US demand. And obviously Trump is fighting that with the prospect of tariffs. So that questions that export-led growth model, and it's possible that with the kind of disruption to German politics that is going on now and an election early next year, that we see some change in some of the fiscal rules that have been overly onerous in Germany that could lead to, for example, greater infrastructure spending in Germany that might boost domestic demand. So kind of redirect the German economy away from export-led growth to domestic demand-driven growth.
But the challenge with that, even so, in the best outcome, which is we do have a strong coalition in German politics. At the same time, the French electorate may be going to the polls again for parliamentary elections, where there's two choices on the ballot paper. One is austerity, and the other is the far right, and that's not. Neither of those strike me as a positive growth mix.
Yeah, so in the past they've managed to cobble together a coalition against the far right, so a protest vote against the far right, but I guess there's a limit to how long that can last if people remain unhappy with their incomes and their overall well-being. So yeah, the French society as a whole is facing some pretty fundamental questions.
So if we then focus in just on markets perhaps, so we've spoken about bond yields and that particularly led by the US, bonds have rallied a bit and yields have fallen.
Yeah.
The clear point for this week is that the US stock market is at all-time highs for both the Dow Jones and the S&P 500. And I guess the context within that is it's no longer just a tech-led rally. It's not what we had at the start of the year, whereas it was the big tech names, Nvidia, Amazon, etc., driving this outperformance. It's now broader based. So it's this growth story is fueling US equity market outperformance.
Yeah, that's something that we had been expecting for some time, was a broadening out of the drivers of the stock market, but both within the US market away from tech to some of the other sectors of the economy, but also geographically away from the US to other countries. The first has started to happen, but the second is definitely not happening. Yeah. So as you say, the rest of the world is significantly underperforming the US year to date and since the election. And that prospect of tariffs on these markets, which are dominated by companies whose revenues are determined overseas, so export-driven companies, is really been a dampener on those markets. And
it's not surprising then that what we have seen in FX markets is a stronger dollar, as FX participants have moved to price, I guess, weaker growth in those markets exposed to any tariffs. But a stronger dollar hasn't been a headwind for US equities, which is perhaps surprising. But again, it does perhaps demonstrate that there is a US demand story there, which can continue through the initial stages of President Trump's term in office.
Yeah, and we spoke about this on yesterday's morning markets, the slight paradox that Trump would desperately like a weaker dollar, but all of his policies point in the opposite direction. So larger fiscal deficits, inflationary policies, perhaps tariffs, all suggest less interest rate cuts and probably promote a stronger dollar. It is possible that we could get some kind of pressure on the rest of the world from the US to strengthen their currencies versus the US. It's been a bugbear of Donald Trump's for years that particularly Asian currencies and to some extent continental Europe have been depressing their currencies at the expense of the US dollar, and that's given them an unfair advantage in terms of international trade. But we'll see. We'll see whether Donald Trump is successful in that.
We will indeed. So there you go, ladies and gentlemen. The US right now is having its cake and eating it. Stock markets are at record highs there. The growth story remains. The data we've seen this week supports the idea of continued robust employment growth. But the European malaise continues to deepen, and there is going to need to be action from politicians in France and Germany very, very soon. That's all this week. Please do like and subscribe on the YouTube channel, and to all our American colleagues and partners, a very happy Thanksgiving. Thank you.
This video is not a recommendation or personal financial advice. With investing, your capital is at risk. Investments can fluctuate in value, and you may get back less than you invest.